we've hedged it. We're short the market and we're long the market at the exact same time. Now we're up $2,400. And at this point, if you have a profit on both contracts, you might at this point want to take your profits and just leave. However, let's just play this out until today's date. And let's say we just said, hey, you know what? We're just going to let it go and see what happens. But at this point right now, you have $2,400 profit, and that's a very decent profit. Now, we have strategies specifically to help you know when to get into positions and when to get out of these hedged positions. And so that's exactly what we teach. Now, let's continue and see how we do. We're still profitable on both sides, which is fantastic. Our hedge is doing what it's supposed to do. It's making us money, even though the long position is making money as well. Hey, it's beautiful. It's a beautiful thing when you can make money on both sides of the hedge. And that's exactly what hedge funds do. Now, we made on our short position, we made $2,329. Let's see how we finish up here on our long position. We are up $706. A total profit of $3,000. And at no time were we down a large amount of money, but we ended up with a profit on both sides, being short and long at the exact same time. For this demonstration, we're going to do the exact same thing we did last time, except this time we're going to be using ETFs rather than futures contracts. So there's no leverage with ETFs. What you buy is what you get. You're not leveraging the index in order to make a greater return with less investment. And instead, you're paying cash for your ETFs. You're paying, unless you use a margin account, of course, but you're using basically no leverage. You're simply purchasing the Russell 2000 and you're purchasing the NASDAQ 100, and the leverage is 1-to-1. With futures contracts, the leverage is much higher. And so for whatever reason, you may not want to use futures. You may want to use ETFs, maybe you feel that they're safer, or they are, futures, because of the leverage, is maybe not to your liking. So let's see what happens if we use the ETFs rather than the futures here. So we're starting at the same time, which is, it's supposed to be 2 o'clock. We're at 1:30 here. Let's see what we are here. We're at 1:30 on both. Okay. So we're at 1:30 instead of 2 o'clock, so just slightly different, but we're at the same time frames on both. So we're going to do the same thing that we did last time. And let me get rid of this. We're going to do the same thing we did last time. We're going to purchase the Qs, and we are going to sell short the Russell 2000. Now, I don't recommend doing this on anything except ETFs, because if you do it on individual stocks, you can get stuck. That's for another time. But right now, we're going to focus on the ETFs. Okay, so we're going to buy the Qs. This is the QQQ Trust, which is the NASDAQ 100 ETF. This is the Russell 2000 ETF. So it's just like buying a stock, except it is a group of stocks. In this case, the Russell 2000. So there's 2,000 stocks in this index, and the NASDAQ 100. There's 100 stocks in this index. So we're going to go ahead and buy these just like we did. We were long. So we're going to go ahead and buy 100 shares of the QQQ NASDAQ 100 ETF, and we're going to sell 200. Oops, I don't want that many. I want 200. 200 of the Russell 2000. So just like we did with the futures contracts. This time I'm just going to let it run all the way to the end, and we'll see how we come out. Now, with the futures contracts, we made about $3,000. This is 100 shares of the Qs. 100 shares times 298, the price on this date, which is March 3rd, would run approximately $29,867. But we sold 200 shares of the Russell 2000 at 191, so we actually get a credit in our account of $38,000. So we have a slight credit on the trade itself, but once again we're protecting this 100 shares with selling short 200 shares of the Russell 2000. All right, so we have some protection here. We're long and short the market exactly at the same time. So let's run through this and see how we come out on both. You can see that if we put we're in a single account here, so we're still having a great deal of profit on one side and a loss on the second side, but we're still up about $2,000. It never went negative, so we're still protecting our 100 shares with the 200 shares short of the Russell 2000. And we're going to let this run all the way to the end. When we had the futures contracts, we made a profit of approximately $3,000 for those contracts, if I recall correctly. Now we have a profit on both sides using ETFs. Now the capital outlay is going to be a little bit higher. So we made a $4,258 profit on our hedge, which was the Russell 2000, and we made $889 profit on our QQQs for a total profit of approximately $5,000, higher than the futures contracts that we ran, but we also had more capital investment. We have to keep 30% of the 38,000 in a margin requirement for maintenance in our short Russell 2000 ETF, or that is approximately $12,000, and we had to have a cash outlay for the purchase of 100 shares of the QQQs, which was approximately $28,000. So our capital outlay was a little bit bigger. But we also made a $5,000 profit by hedging, using hedge fund strategies in order to be long and short the market at the exact same time so that we could protect our position. I've been in the markets since 1976. I started trading options in 1987. I started trading futures and commodities, crypto, and I traded just about anything that I could find. This is the best strategy for investors, individual investors now applying hedge fund strategies because of the technological advances. Using the law of large numbers does not apply, because if you're an individual, generally speaking, you're probably not going to have $100 million in which the law of large numbers is going to apply to you. But if you have $50,000, $100,000, $500,000 to trade with, this is the way that hedge funds back in the 70s and 80s have generated 30, 40, 50, 60, 70% returns annually. And I'm going to teach those to you because I have been in the market that long. I've seen the history. I understand the strategies from the 70s and 80s and even now, and I know that the technology has advanced because I've been in the internet space now as an entrepreneur since 1996. I've seen the technological advances in trading platforms, and so now you have the best of both worlds. You're not subject to the law of large numbers. You're small enough and nimble enough to be able to get in and out of positions very, very quickly. and we have the technological advancements that are in your favor to be able to apply these hedge fund strategies in a very profitable way. These are the strategies that I teach, and I hope you join us. Continue to watch additional videos for more information. If you have any questions at all, please contact me, and I'd be very happy to answer them.